Hi everyone, this is Prashad Parthiban. Today I'm going to explain the differences between excess and surplus policy and excess casualty policy. Because of the fact that the term excess is kind of repeated in both this type of policy, people have hard time understanding the differences. So let's see what do you mean by excess and surplus policy. This type of policy is basically for customers with adverse loss experience, which means they have a lot of loss in the past couple of years, or unusual risk, like say if you take oil company in this example, if something happens to the oil company, the loss could be huge. So it's very difficult for an insurance company to evaluate or come up with the estimated premium. So those type of customers, when they go to traditional insurance companies like admitted carriers, they don't get the policy because of their unusual risk. So in those scenarios, they need to go to non-admitted carriers, which means they are the type of carriers who need not file their rates or forms to the respective states because of the fact they are covering this kind of customers. If you want to understand in detail about the differences between admitted versus non-admitted, I will give you the link in this description from my past training video. So the fact I wanted to be explaining here is excess and surplus policy is nothing but a non-admitted policy which covers unusual risk, otherwise a customer with adverse loss experience. Couple of examples if you see here, construction business or oil company, they all can take their policy under non-admitted carriers, which is otherwise called as excess and surplus policy. Now let's see what do you mean by excess casualty policy. By definition, it provides coverage limit in excess to an underlying liability policy. Example, if you are a company, you have your liability limit, which is say 1 million, right? If you see this example, but you think that the 1 million will not be sufficient, but the primary policy have the maximum of 1 million, then you can get this excess casualty policy, otherwise called as excess liability policy, which gives you additional 1 million, which is excess to your primary policy. So if there is a claim, say for 1.5 million from a customer, then the primary policy will cover initially. Like in this case, if you see, we have a customer A with the general liability limit as 1 million and excess casualty limit as another 1 million. He had a claim for 1.5 million. Initially, the general liability policy covered them 100% for 1 million, and the excess of 0.5 million is covered by excess casualty. So this is what we mean by excess casualty. So I hope you got the difference between excess and surplus policy and excess and casualty policy. Thank you. Bye-bye.